Global real estate represents nearly 60% of all total assets. No wonder it is a crucial part of the world's economy. Even though it is undoubtedly a popular investment, there is still some controversy.
The best investment for an individual, an average individual, is to buy their own home.
By its nature, real estate tends to be a very lousy investment.
Who should we trust? In today's episode, you will learn why real estate became a profitable investment, how the U.S. housing market became what it is today, and what are the benefits and downsides of real estate investing. This is how the median house prices in the US change over the years. According to the Census Bureau, in the third quarter of 2022, the median price of a sold house reached the historical peak of $468,000. The crazy thing is that only 10 years ago, you could buy 2 homes for the same amount of money. However, if we check the real median household income, its growth isn't that fast. In the last 10 years, the median household income saw an increase of only 17%, barely reaching $71,000. By the way, we're comparing the median values because in this case, they depict a more accurate picture than the average values. This is because the sales prices of some properties are considered extreme values and don't necessarily reflect the average situation. Having said that, let's go back to housing prices. Why did the value of real estate increase that much and that fast? Well, several factors influence property prices, such as area popularity, for example. When more people are moving to specific regions, the prices go up because the land is limited, which is particularly true for urban areas. Sometimes the popularity can also grow because of the news. For example, when Elon Musk started building a new Giga factory in Travis County, Texas, home prices in the area went up almost 54%. The next factor that influences property value is inflation. It makes the cost of all goods and services rise, and real estate is no exception. That's why properties can gain in price over time without any value-added changes. Economic growth also influences pricing. When the economy is growing, people tend to have higher incomes, and as a result, the demand for housing increases, which drives property value up. Next come the interest rates. When they're low, borrowing money is easier, so buying real estate becomes more attractive. And another price influencing component is supply and demand. When the demand is higher than the supply, prices go up and vice versa. A great example of this will be California. According to the California Association of Realtors, in the third quarter of 2022, the state's median home prices was almost $830,000. It is twice as much as the typical US home price. Here, it's what high demand and low supply can do to a market. But of course, there is high demand not only for buying properties, but also for renting them. Anywhere from 50 to 60% of Americans say that they either don't want to purchase a property at all or that they can't afford it just yet. So the renting business, it's also flourishing. According to the IRS, 10.6 million Americans earn income from rental properties. The average landlord owns 2 to 3 properties, but it's worth mentioning that 40% of owners have their real estate value below $200,000, while only 7% own properties worth $1 million or more. Many believe that corporations hold most rental properties, but it isn't quite like that. According to Congressional Research Service, individuals own 70% of rental properties and around 38% of rental units. LLPs, LPs, LLCs, they possess around 15% of rental properties and 40% of rental units. While real estate investment trusts, REITs, together with real estate corporations, hold only 1.2% of rental properties and 4.3% of rental units. It is worth mentioning that LLPs, LPs, or LLCs may be both individual owners and institutional investors. So the actual share of rental properties and units in hands of corporations may vary. From individuals to giant corporations, we can see that real estate is in demand for different types of investors. But what is the reason for its popularity? One of the common reasons is safety, and the words of Franklin Roosevelt may reflect the opinion of many real estate investors. Real estate cannot be lost or stolen, nor it can be carried away. Purchase with common sense, pay for it in full, and manage with reasonable care. It is about the safest investment in the world. Is it the safest investment though? Technically speaking, the US Treasury bonds are the safest investments of all because the American government has never defaulted on its debt. Then, any list of low-risk investments will include gold, high-yield savings account, certificates of deposit, CDs, Series 1 saving bonds, corporate bonds, and of course, real estate. But its safety highly depends on the local conditions and the selected investment strategy. Real estate offers several investment opportunities, such as the purchase of rental properties or investing in real estate funds and trusts known as REITs. The last ones are considered slightly riskier, but they give exposure to real estate with greater liquidity and lower cost. Now, you might be wondering, if those are the safest investments, what are the most profitable assets? Of course, it depends on market conditions, investment strategy, and individual risk tolerance. But the general average over the long term is around 10% for stocks, 5 to 6% for bonds, and 8 to 10% for real estate. Based on this data, real estate seems relatively safe and profitable compared to other investment options. But what pitfalls should you be aware of before investing in real estate? Let's dive deeper into both pros and cons of real estate investments. There are several reasons why investors see real estate as a good asset. First is appreciation. Historically, real estate increased in value over the long term. This appreciation can lead to significant capital gains when investors purchase property at a low price and sell it for a higher price later on. Another benefit is cash flow. Real estate can generate rental income, which might mean a steady stream of cash flow for investors. That's why real estate is one of the most popular sources of passive income. Tax benefits. Deductions for mortgage interest, property taxes, and depreciation can all reduce the overall cost of owning and maintaining a property. Another possible advantage could be inflation hedge. You see, when the cost of living goes up because of inflation, property values increase, which is a good thing if you're a property owner. Additionally, real estate is much less volatile compared to most investments. Its worth tends to remain stable even during economic downturns. And last but not least, real estate is a tangible asset that investors can see and touch. By being less abstract than stocks and bonds, real estate is often more attractive to some investors. But what is the downside of real estate investment? First of all, high upfront costs. Down payments, closing costs, and other fees make it more difficult to enter the real estate market than, let's say, investing in the stock market. The good news is that there are programs out there that can help you access real estate with as little as 3% down. And in this video, I'll tell you all about it. Feel free to check it out after you're done with this one, of course. Another possible vulnerability is market fluctuation. Even though real estate might be less volatile than other investments, it still responds to market changes. For example, after the crisis of 2008, real estate saw a 27% decline in value. One of the biggest downsides of owning rental property is maintenance and repair costs. It might not only be expensive, but also time-consuming. And unless you have a property manager, your real estate business can't fully be passive because you will still have to take care of the place. Another issue worth mentioning is liquidity. Compared to other investments, real estate is typically less liquid, which means that it can be more difficult to sell a property quickly if needed. If you only rely on real estate investments, you might be less flexible and less agile in responding to changes and market conditions. Despite all the potential downsides, real estate still has numerous supporters and firm believers, like Robert Kiyosaki, author of Rich Dad, Poor Dad. He has owned over 7,000 properties, including residential and commercial ones. Now, his net worth is around $100 million. Even though Kiyosaki made both his name and fortune in real estate, he doesn't call himself a real estate investor, but rather a businessman who uses real estate. Real estate is my favorite investment for many reasons. It offers cash flow, builds equity, and appreciates over time. Kiyosaki is famous for creating the BRRRR real estate investing strategy. The BRRRR method involves buying the property, renovating it, renting it out, refinancing, repeating the whole process with other properties. This strategy looks great on paper, and many investors use it. But of course, there might be several issues with this method in the real world. Sometimes it is hard to make the numbers work because the rehab costs could end up higher than expected, while the appraisal could end up being lower than you would have wished. Even though today there are so many talks on real estate investing strategies, home ownership wasn't always a thing. And what we all know as part of the American dream was rather an exception not that long ago. Before the Industrial Revolution, only farmers were likely to own a land and house. But during the 19th century, home ownership became more common in urban areas as well. In this graph, you can see that in the early 1900s, over 40% of Americans already own a home. Now, this number is around 66%. Seems like a very modest growth for more than a century, doesn't it? But we should also remember that in 1900s, the US population was around 76 million, whereas now it is over 330 million people. So if we compare the number of Americans who own a home back then versus now, we will get around 35 million versus almost 218 million people. That's 6 times more people. So yes, the growth was pretty notable, but back in the days, people view properties as a commodity rather than an investment. What changed then? What made real estate a popular investment? To answer that question, let's have a closer look at the 20th century and go through the key events that shaped the US housing market. An important boom happened after World War II. The demand grew exponentially as millions of servicemen returned home and started families. This led to suburban development and a boost in home ownership. It still wasn't that much about the investment, but this period influenced the real estate market strongly, driving growth and innovation in the industry. This happened due to several factors, such as the start of suburbanization. It is hard to imagine the US real estate market without suburbs, right? Well, it wasn't like that until the end of World War II, when people started to move from urban areas to the suburbs. At that point, developers started building many single-family homes and townhouses. This booming time led to high housing demand, which fueled the growth of the market and led to home price increases. In that same period, mortgages got more popular and affordable. They've existed in the US before, since the 1860s. But the truth is that the conditions weren't the best. For example, a typical mortgage in the early 1900s would have a term of 5 years and require a 50% down payment. Not the best deal out there. So what happened in the post-World War II period was that the Federal Housing Administration, FHA, and the Veterans Administration, VA, both introduced programs to make mortgages more affordable with relatively small down payments. The next important milestone were innovations in the construction sector. Developers looked for ways to reduce costs and increase efficiency, which led to several technical advancements, such as prefabricated building components, standardized designs, and new materials like concrete and steel. This period was a foundation for building a solid housing market in the US. The next important chapter of the US housing market happened in the 1970s. Real estate got popular as an investment because of multiple aspects. The first reason was recession. Cash was actively losing its value, so people wanted to invest in something relatively stable. And real estate appeared to be a solution. If we go back to the chart with the median house price, we'll see that despite the recession, house prices almost tripled from 1970 to 1980. This was the period when real estate got its name of the inflation hedge. Another factor that made real estate an attractive investment was tax benefits. The US government introduced a series of tax incentives, including the ability to deduct mortgage interest and property taxes from taxable income. Another important aspect was urban renewal. In the 1970s, many American cities were undergoing urban renewals. This created an opportunity for investors to purchase and renovate properties in the soon-to-be trending neighborhoods. Another event that heavily influenced the market was the housing bubble and the crash of 2008. We all know the story, we all lived through it, so let's not stop here. But what not many people talk about is the period of recovery and expansion. You see, the economy is cyclical, and after every slowdown comes growth. This is exactly what happened after the 2008 crash. Interest rates remain low, making it easier for buyers to afford homes. So eventually, there was a new surge in demand for construction, particularly in urban areas. Apart from historical events, there are also other relevant details, like generational preferences. For example, what worked for baby boomers might not work for millennials, and most certainly will not work for Gen Zs. We also shouldn't discard the overall changes in people's lifestyle. For example, tech advancements and workplace transformations allow remote work, which leads to increased demand for larger homes with home offices and outdoor space. Overall, the housing market in the United States experienced many ups and downs over the years, influenced by economic conditions, demographic shifts, and technological advancements. But still, all that didn't make real estate investment less popular or profitable over the long term. And the truth is that the general rule of thumb for investing is to have a long-term strategy and diversify your investments, no matter what the assets are. Real estate can be a great addition to your portfolio if you know how to evaluate your deals. And if you are in the search to learn how to invest in real estate the right way, feel free to join this free webinar. See you in the webinar. Bye-bye.